Ripple might buy PayPal. That's the headline bouncing around crypto circles right now. A $40 billion company potentially acquiring another $40 billion company. And the moment that rumor hit, XRP holders started calculating what this means for the token price. $9, $15, some are saying $50. But here's the question nobody's asking. Even if Ripple successfully acquires PayPal, and that's a massive if, why would that automatically make XRP more valuable? Pause on that for a second. Because the assumption underneath that question reveals one of the most expensive mistakes retail investors make. The belief that when a company does something big, the assets associated with that company must go up. That logic sounds reasonable until you examine how value actually flows in corporate acquisitions. And what you discover is uncomfortable. Most of the time, the people who profit from these deals aren't the ones holding tokens or hoping for price appreciation. They're the ones who understand what's actually being bought, who's paying, and where the value accrues. If you're here because you want to understand money differently, not just follow the crowd, subscribe. Because what comes next is going to challenge some deeply held beliefs about how markets actually work. Let's get into it. Let's start with what's actually on the table. PayPal's market cap has dropped more than 46% over the last year. It's now valued around $38 billion. The company is struggling. Payment volumes are flat. Growth has stalled. They just fired their CEO and brought in new leadership. Ripple, on the other hand, just raised $500 million at a $40 billion valuation. They've been acquiring companies aggressively. Metaco for $250 million. Hidden Road for $1.25 billion. Treasury Services for another billion. They're building infrastructure. Fast. So the speculation goes like this. Ripple has momentum. PayPal needs a savior. Ripple has blockchain technology. PayPal has 400 million users. Put them together and suddenly you've got a company that bridges traditional finance and crypto. A payment giant powered by blockchain rails. And XRP holders hear this and think, this is it. This is the catalyst. Institutional adoption, real-world use case, mass integration. But let's slow down and examine what's actually happening if this deal were to go through. First, the money. Ripple's valuation is $40 billion. PayPal's market cap is $38 billion. But acquisitions don't happen at market cap. They happen at a premium, usually 20 to 40% above current trading price. That means Ripple would need to pay somewhere between $50 and $60 billion to acquire PayPal. Ripple is a private company. Most of its value is in equity, not cash. To pull off a deal this size, they'd need a combination of debt financing, strategic partners, and probably equity swaps. This isn't a simple transaction. This is a years-long regulatory and financial gauntlet. And here's where it gets interesting. Even if Ripple structures the deal, even if they secure financing, even if regulators approve it, what are they actually buying? They're buying PayPal's payment infrastructure, its user base, its brand, its relationships with merchants and banks, its regulatory licenses across dozens of countries. Notice what's not on that list? Automatic XRP adoption, mandatory token integration, price appreciation for existing holders. This is where most retail investors make the critical error. They confuse company success with token value. Let me explain the difference because this is where billions of dollars in misplaced expectations live. When a company like Ripple acquires another company, they're buying revenue streams, technology, market share, and competitive positioning. They're strengthening the business. That makes the company more valuable. If Ripple were a publicly traded company, this might boost the stock price because shareholders own a piece of the growing business. But XRP isn't equity in Ripple. It's a separate digital asset that Ripple created and still holds a significant portion of. The token's value is supposed to come from utility, from being used in transactions, from demand in the market. So the question becomes, does acquiring PayPal automatically increase demand for XRP? Does it force PayPal's 400 million users to suddenly start buying and using XRP? Not necessarily. In fact, probably not at all. Here's why. PayPal already has its own stablecoin, PYUSD. Ripple has its own stablecoin, RLUSD. If these companies merge, the most likely scenario is they unify around one of these stablecoins or create a new one. Stablecoins are what payment companies actually want. Predictable value, no volatility, regulatory clarity. XRP, on the other hand, is a bridge asset. Its designed use case is moving value between different currencies quickly. That's useful for banks doing cross-border settlements. But for consumer payments, for buying coffee or paying rent, stablecoins do that job better because they don't fluctuate. So Ripple could acquire PayPal, integrate all the technology, serve hundreds of millions of users, and XRP might barely factor into the equation. But retail investors don't think about it that way. They see the headline, Ripple acquires PayPal, and their brain fills in the rest. Adoption, integration, demand, moon. This is narrative thinking, and narrative thinking is expensive. Let's zoom out and look at this through the lens of institutional investing versus retail speculation. When a company like Ripple makes an acquisition, they're executing a business strategy. They're thinking about revenue synergies, cost reductions, market positioning, long-term competitive advantage. None of that is designed to make XRP go up. It's designed to make Ripple Labs, the company, more valuable. If Ripple were a public company and you owned shares, you'd benefit directly. The company gets stronger, your equity stake becomes more valuable. That's how stock ownership works. But XRP holders don't own equity. They own a token. And that token's value is determined by supply and demand in the open market. If demand doesn't increase, the price doesn't increase. It's that simple. Now, could the acquisition indirectly create demand for XRP? Sure. If the combined entity decides to use XRP as a settlement layer for certain transactions, that creates real utility. If they build products that require holding or using XRP, that creates demand. But that's a long chain of ifs, and it requires Ripple to choose XRP over alternatives that might be easier, cheaper, or more compliant with regulations. This is the psychological trap. Big news sounds like it should equal big profits, but the pathway from news to value is almost never direct. Most of the time, the value accrues to the people who structured the deal, the company that gets stronger, the insiders who understood what was actually being bought. Retail holders get the narrative. Insiders get the value. Here's another uncomfortable reality. Let's say the acquisition happens. Let's say it's wildly successful. Ripple and PayPal merge. The new entity processes trillions in payments. It becomes the dominant player in global digital payments. That still doesn't mean XRP holders profit. Why? Because Ripple Labs, the company, still holds billions of XRP. If the token price rises, they benefit. But they also control the supply. They can sell when they want. They can issue more if needed. They can structure deals where partners receive XRP as part of payment agreements. In other words, the company has optionality. They control timing, distribution, and use cases. Token holders, they have none of that. They can only buy, hold, or sell based on market conditions they don't control. This is the asymmetry that most people never consider. The entity that benefits most from the acquisition is Ripple Labs. The entity that might benefit secondarily is XRP. And even that's not guaranteed. Now layer in the regulatory complexity. Ripple just won a major legal battle with the SEC. That's good for them. But acquiring PayPal would put them under an entirely different set of regulations. PayPal is a registered money transmitter. It operates under banking regulations in multiple jurisdictions. If Ripple acquires it, they inherit all of those regulatory obligations. They'd be subject to Federal Reserve oversight, FDIC reviews, anti-money laundering requirements, consumer protection laws. Every regulator in every country where PayPal operates would need to approve the change in ownership. That process alone could take a year or more. And during that time, there's zero guarantee that XRP factors into the conversation at all. In fact, regulators might prefer the combined entity to use stablecoins or traditional rails specifically because they're less controversial than a volatile digital asset. So what's the better question to ask? Instead of, will this acquisition make XRP moon? Try this. Where does value actually flow in corporate acquisitions? Value flows to the company that becomes more efficient, more dominant, more profitable. Value flows to shareholders if it's a public company. Value flows to debt holders if the acquisition is leveraged. Value flows to strategic partners who helped structure the deal. Value rarely flows automatically to holders of a speculative asset that happens to be associated with the acquiring company. This isn't pessimism, it's financial literacy. The difference between company success and asset price behavior is one of the most important concepts in investing, and it's one of the least understood. People see Apple release a new iPhone and assume Apple stock goes up. Sometimes it does, sometimes it doesn't. Why? Because the market already priced in expectations. The news was anticipated. The growth was modeled. The stock price reflects forward-looking assumptions, not just what happened yesterday. Same logic applies here. If Ripple acquires PayPal and the market already expects XRP to benefit, then that expectation is probably already priced in. The people who bought early on the rumor, they might profit. The people who buy after the announcement, they're often buying the top of the hype cycle. This is why narratives are dangerous. They feel true, they sound logical, they get repeated until they seem like facts. But markets don't care about narratives. Markets care about cash flows, real demand, measurable utility. If XRP develops genuine, sustained demand because of increased utility, the price will reflect that over time. But that's a fundamental story, not a hype story. And fundamentals take time to play out. Years, not weeks. Let's talk about what actually creates value for a digital asset, because this is where the conversation gets interesting. A token becomes valuable when it has utility that can't easily be replicated, when it solves a problem, when holding it or using it provides access to something people want. Bitcoin has value because it's decentralized, scarce, and widely recognized as digital gold. People hold it as a store of value. That creates demand. Ethereum has value because smart contracts run on it. DeFi protocols use it. NFTs are built on it. Developers need ETH to deploy applications. That creates demand. XRP's value proposition is speed and low cost for cross-border payments. It's designed to be a bridge currency that banks and institutions use to move value between different fiat currencies without pre-funding accounts. That's a real use case, but it's a narrow one. And it requires institutions to choose XRP over alternatives like stablecoins, SWIFT improvements, or central bank digital currencies. So the question isn't whether Ripple acquiring PayPal is good news. The question is whether that acquisition increases the specific utility that makes XRP valuable. Does it create more cross-border payment volume that requires XRP as a bridge? Does it force institutional adoption of the token itself? Maybe, maybe not. And that uncertainty is the point. Retail investors assume the answer is yes because they want it to be yes. Institutions evaluate the answer based on cost, compliance, and competitive advantage. Those are very different frameworks. Here's the mindset shift that changes everything. Stop thinking about crypto as a way to get rich quick. Start thinking about it as a way to understand how value actually works in modern financial systems. Blockchain technology is real. It has applications. It will likely transform parts of the financial infrastructure over the next decade, but that doesn't mean every token associated with that transformation will be valuable. Most won't. Just like most dot-com companies in the late 90s didn't survive even though the internet clearly had a future. The internet was the technology. Amazon was one of the companies. Most investors who bet on random internet stocks lost money. The ones who identified actual business models with competitive moats, those are the ones who built wealth. Same principle applies here. Blockchain is the technology. Some companies will dominate. Some tokens will have genuine utility. Most will fade into irrelevance. Your job as an investor isn't to chase every headline. It's to understand which projects have real utility, sustainable business models, and competitive advantages that can't easily be copied. That requires skepticism. It requires asking uncomfortable questions. It requires being willing to say, this sounds bullish, but where's the actual value flowing? Most people never ask that question. They just ride the hype, and hype has a pattern. It spikes, It crashes. It leaves most participants worse off than when they started. The people who win are the ones who bought before the hype or sold into it. Everyone else is exit liquidity. So where does that leave you with the Ripple PayPal situation? If you're holding XRP because you believe in its long-term utility as a bridge currency for institutional payments, this acquisition news doesn't change your thesis. Either the technology will get adopted or it won't. Either institutions will choose XRP or they'll choose something else. That's a multi-year story that plays out through usage data, not headlines. If you're holding XRP because you think this acquisition will cause the price to spike, you're speculating on narrative, not fundamentals. And narrative speculation is a game where the house always wins. The house being the people who got in early, who have more information, who can move markets. You're not wrong to find this space interesting. You're not wrong to want exposure to blockchain technology. But clarity matters. Knowing what you own and why you own it matters. XRP might go up. It might go down. It might do nothing for years. None of that changes whether blockchain payments have a future. But it does change whether you're making a smart investment or gambling on stories. The smartest thing you can do is separate the technology from the speculation, learn how the systems work, understand where value comes from, build conviction based on fundamentals, not hype. And if you're going to hold any asset, crypto or otherwise, know what you're betting on. Are you betting on Ripple Labs succeeding as a company? Or are you betting on XRP being adopted as a payment rail? Those are related but not the same. Company success doesn't automatically equal token success, and the sooner you internalize that, the better your investment decisions will be. If this changed how you think about crypto narratives versus reality, subscribe. We're here to cut through the noise and explain how money actually works, not to sell you hype, not to make predictions, just to give you the tools to think clearly about what you're doing with your money. Drop a comment if this reframed your perspective on the PayPal acquisition news. Let's talk about it, because the more people who understand the difference between headlines and value, the fewer people get burned by speculation. Real wealth isn't built on hopium. It's built on understanding. And understanding takes time. It takes skepticism. It takes being willing to say, everyone else is excited, but I need to see the actual mechanism of value creation. That's the mindset that protects you. That's the mindset that compounds. That's the mindset that lets you sleep at night, regardless of what the charts are doing. This isn't about being anti-crypto. It's about being pro-clarity. And clarity is the most underrated edge in investing.